here that was pretty, there's a lot of moving parts, let's just say that. So I'm going to kind of share a lot of the details about the deal, and then would love to answer any questions you guys have about the deal. But there's a lot of different, the reason why I picked this one, originally I was going to do a 93 unit, but this one is a little bit more seasoned. We've had it for a couple more months than the 93 unit. And then also this one has a lot of moving pieces. And so I think everyone would probably enjoy kind of the sophistication of this event. So let me share my screen here.
Right. And Kyle, you're okay with me recording it, right?
Yeah, absolutely.
Okay, perfect.
And just want to make sure everyone can see my screen.
Yeah, we can see your screen.
Okay, perfect. All right, so this is the property. It was called Bella Vista. It's now been rebranded to Midtown on Seneca, and it's a 176 unit investment opportunity. And we found this through a broker. And originally it went to full market. We did a best and final round. We were one of 3 final people that did seller interviews. And then all of a sudden the sellers disappeared from the brokers. We don't know why. We didn't know why. We couldn't get a hold of them. Broker couldn't get a hold of them. And come to find out that their prepayment penalty was $1.3 million higher than they anticipated. Okay, so originally they thought their prepayment penalty was $500,000. They found out it's 1.8, and so they kind of walked out of the deal and said, "Sorry guys, we can't do this anymore." And so we were kind of left there, kind of shocked, because we had spent a month doing our due diligence on this property, underwriting for it, going to best and final. We were at $14.65 million for this property at that point. And the cool part about this is we ended up buying it for $13.6 million. So over $1 million less than our highest offer at a point. And the reason was because we decided to try and solve a challenge that the seller was having. And I think that is the best way to find deals now. You know, you're not going to be able to find on-market deals that are just posted by brokers and be able to get a good deal. If you want to get a good deal, you have to solve someone's problem. And that's what we did here. We asked the broker to ask the seller, what would this look like if we assume the loan? So what a loan assumption means is we assume the existing loan. So we take on everything there is with the loan, the interest only periods that had evaporated and were no longer there, the interest rate that they bought the deal at, the maturity dates, everything to go along with that. So that eliminated the $1.8 million prepayment penalty. And so the broker said, okay, let me go see what we can do and what the price they want is. And they said they'd give us over $1 million discount. And so we underwrote it at that. We made the offer and we made it happen. And so because of that, you know, we were able to get our largest asset in Tucson and close on this deal, which has been a fantastic deal so far. And I think we really got a steal. So I'll go more into the details, but that is kind of the high level behind it. We had to raise $8 million on a $13.6 million deal because with assumptions, typically you have to put more down because you're not getting a lot of leverage. So we had to put 42% down on this property. We have a $2 million budget or $1.8 million budget for rehabs. So we actually also had a preferred equity partner. So we had one partner bring in a check for $5.9 million. The remaining 2.1 we raised ourselves. But that was another piece of the puzzle that had to be fit in to make the returns work for our investors. But it also definitely introduces a little more risk on certain aspects as well. So I'll talk about that piece. So there's a lot of moving pieces in this deal, which is why I like to present it. All right, APT Capital Group is our company. Gary Lipsky is my business partner. He lives in Manhattan Beach, Southern California. I lived there until about 10 days ago when I moved everything out here to be closer to our assets and really focus on acquiring more properties. I do think that there's a competitive advantage to living in your market, understanding your market, building relationships in your market. And so now I can drive to a property in 5 minutes, whereas someone needs to hop on a flight. So that was the main reason for that move. So we've got 41 million of assets under management. Actually, that number is 3 million less. We actually just sold our first property that we bought in Tucson. We bought that less than 2 years ago. We just exited it yesterday. So that was our first full cycle deal. And I'll show you that deal here in a little bit. And then Gary and I focus on the asset management side of things. So we actually have a free summit that we host every year. It's called the Virtual Asset Management Summit. You know, there's a lot of education out there that talks about how to get your first deal, how to raise capital, but there is no education on what you do once you buy the property. And there's a lot of talk about, oh, I just hand it to my property management company and they'll take care of it. And, you know, that's the wrong way to handle this. And you're certainly losing money if that's the route you go. So we focus heavily on the operations and management side of things, managing the manager, things like that. We've got an asset management mastery podcast that's every Friday that talks about very specific things on asset management. And then we also have a book coming out in June 29th called Best in Class. And that focuses on all things asset management as well. All right, so some of our strengths as a sponsor are we're focused only on the Arizona market, so we can be the experts. Again, why I moved to Arizona, so I can be the experts here. We're not the group that's going to do 5, 6 different markets. We are very relationship driven, and we want to make sure we understand and we're the experts in that market. You know, when you're going into a new market, you've got to hire a property management company. You've got to hire, you know, local attorneys, you got to hire general contractors. And so if you don't have those teams built in advance, you're in a very big disadvantage. Like I talked about earlier, property management companies are going to execute your business plan and you need to find the right teams. And so if you're going in new market, just picking people that are, you know, maybe referred as the best property management company, you know, your team's not going to be as strong as if you stick to a couple of markets and do them very well. Strong local partners, I already mentioned that. This was our pitch to our investors on this one, so I won't pitch you on that one. You know, very selective with the properties that we choose. Before we closed on this property, it had been 13 months between properties. So it's kind of interesting. Our first deal we did in May 2019. 3 weeks later, we got our second deal. We went 13 months till our third deal. And then 2 weeks later, we got our fourth deal. So it's very interesting, that gap, but we're very selective in the deals that we do. And we've been patient on acquiring deals, kind of going back to, I forget his name, but was mentioning about being conservative and underwriting. We're very much the same way. And then asset management is our secret sauce. We have over 50 years of combined management experience. And that's kind of what our strength is as a sponsorship group. Here's some of our portfolio. As I mentioned, Midtown on Second, that one on the top left, we actually just sold that one yesterday after 23 months. And so that was a wonderful investment for us, 42 units. It was our first property. Sad to see it go because it really didn't have any bumps in the road, any issues. And you don't typically see that of real estate investments, but it really went well. Top right is our latest acquisition, Indy Tucson. It's actually student housing, but we're moving it over to multifamily. So we're in the lease up phase of that one right now. Midtown on Seneca, which is the one I'm presenting today. And then we've got another property in Phoenix, East 3434, 128 unit, typical value add project. All right. I won't spend too much time here because I'm not pitching you on anything here, but Tucson, we really love the Tucson market. It's been number 1 and number 2 nationally on rent growth for a long time. They're one of the top 20 affordable cities in the nation. So that means there's tons of room for growth still. And their occupancy, while their rents are going up, their occupancy is still going up as well. So we like to see that. And then their job diversity has been something that's been very strong, something that they've changed over the last, since 2008. They were heavily reliant on construction jobs. And so that would not have been a market I would have picked in 2008 because they were so reliant on one industry. But they've done a nice job over the last 13 years diversifying their jobs, which is one of the main reasons why we love Tucson. It is a smaller market, so there's less inventory, but we really like the things that they've got going on there, and they trail Phoenix, which has been absolutely on fire. So they've got a lot of different, jobs and industries, and you're seeing a lot more tech jobs come into Tucson as well, which means higher paying jobs, $90,000, $100,000 plus jobs, which means there's going to be even more room for rent growth. This is an overview of the location of the property, close to a lot of different things. Our other property was right here, right by the Whole Foods that we just sold, but we know the area well, right? So that's a benefit also of being in one market or maybe two markets, is as you add to your portfolio, you start to understand what rents you can get for certain units, what level of renovation you need to do to get those rents. Maybe you need to back off a little bit, but if you always are going into a new market, you're going to be learning these things as you go. We have already established our portfolio, so we know these types of things. How much can you get away with payroll and expenses? You know, how much can you push the rents? Are there other income lines that we can reintroduce to a property that maybe we didn't think about at first, but we are now? And so that's really helped us and benefited us in our underwriting of future deals, is because we have that local knowledge. All right, so here's a couple of property photos. You know, they have some really nice amenities at this property. They've got a basketball court, several laundry rooms, pool area, barbecue areas, dog park, plenty of grass areas. So we really like this property. It's our largest from a unit count, not from a dollar count from price per unit. More property photos. And here's the interiors. One thing I really liked about this property was 117 of the 128 two bedrooms were already renovated. And so I think that overall there was only 7 units that weren't renovated totally. So this is the makeup of most of the interior units, which actually look pretty good. And our business plan is just to take this up a notch. Really, we're just gonna change out the white appliances with black. We're gonna add some, you know, some pulls on the cabinets, and upgrade the lighting package. That's it. So we're really not spending a lot of money here, and we're gonna be able to bump the rents up quite a bit. And in fact, we've already raised our market rents from where we initially started 3 weeks ago or 3 months ago. So we're already getting the rents that we need and then some. The key on this property, and I'll talk about it a little bit later, is this property management company who owns this, who ran this property before us, was known for not pushing rents, was known for just getting 100% occupied, and that was it. And so if you get a good, strong management company in there, you can push these rents. So we're getting market rents without even putting a dollar back into the property right now. A little bit more on the details of the property. One thing to note is this is a boiler chiller property. And so what boiler chiller properties are is they're master metered, meaning the owner pays for all the utilities and then you can bill back if you want, but the mechanicals are old. This is a 1972 property, and the boiler chiller does serve a little bit more risk in the sense that they're very old. The airflow to the units is not great. And it can be quite expensive to actually fix and maintain. So the expenses are typically much higher on a boiler chiller property. Number one, the utilities that get billed back, but also the repairs and maintenance that are required to maintain that unit day in and day out. So one of the biggest things that we're doing at this property is we're spending $800,000 to redo the pipelines. And that is going to create better airflow to the units, and it's going to reduce the amount of leaks in the pipes right now that there's a lot of. So day-to-day expenses will come down, and it will just have us have just a much more efficient system, and not focusing on all the repairs and maintenance on that. Floor plans, so really good size floor plans, especially for Arizona. You know, you can cut these square feet in half and you can see 2 bedrooms in the 400s. So we really like the unit mix. These are also 2-story townhomes for the 2-bedroom, 1 bath. So they're really large units, upstairs, downstairs. So you don't have anyone living below you, which is or above you, which is fantastic. So we really like the unit mix here. And here is kind of the occupancy when we first took over. You know, they're at 95% occupied, and they were charging, you know, $673 for 1 bedrooms. Our goal is to get them to $759, and like I said, we're already getting $759. No renovations for the property at all. Current in place on the 2 bedrooms, which there is the most of for sure. This is the one that we had to look out for. We knew if there was one unit type that we could not fail on for the rents, it had to be the 2 bedrooms because there's so many of them. So we want to take the 838 to 984. We're already at 999 and getting that. So we feel really good about that. And we have not even started the interior unit renovation. So we'll probably be able to up that by about $50. And then 3-bedroom, 2 baths, 1340. These are already at 1400 because of the high demand for 3 bedrooms at this property, especially because there's only 8 of them. All right, so here was our business plan. Really, it was just burning off loss to lease, right? So like I said, this property management company was known for not pushing rents. We raised the market rents right away, in some cases $175, and we were getting it from day one. So now our goal is to burn off the loss to lease, which means getting the difference between what current residents are paying to what our market rents are now. And some of that is going to have to be a lot of turnover. People that just can't afford it will have to bring in new residents. But one thing we found out about this property during due diligence is they have 55% Section 8 residents. And that's a good thing when you're in COVID and you need to get rents collected. You know, they're all going to pay rent, but it's just not a good demographic. And so we've had a little bit more crime than we've wanted to. People staying home during the day all day long. And then obviously they cannot afford the new rents. Section 8 will only pay a certain amount for the rents. And so we are turning over that demographic. That's the biggest challenge with this property. And the one thing that we're really heavily focused on is turning over the resident base to get a better resident base in there that can pay higher rents, that is nicer to the property, treats the property better, and can pay those higher rents. We are rebranding. We just rebranded to Midtown on Seneca. This property is known as a Section 8 property. It is known for crime. It did have bad reviews. And so one of the things we did was change over the name and trying to start to get that property with a new reputation. We are going to update 117 of the 2-bedroom units. Why that number? It's basically because it's, what is it? It's like 70% of the property. And that's always our business plan, is to leave a little meat on the bone for the next buyer. So we're not going to renovate 100% of the units, because then that would be essentially a turnkey property. You always want to leave a little bit of meat on the bone for the next buyer so that they can get their value out as well. So we're going to leave 30% of the units for them. We're going to lower our maintenance and utility costs by upgrading the chiller and installing desert scapes. So I talked a little bit about this as well. We're also reducing the amount of turf in areas so that we don't have to utilize water in a lot of the grass areas. So we're going to be removing quite a bit of that. And we also have areas that have grass that are right up against the stucco of the property. So the sprinklers are shooting onto the stucco and damaging the building. So any part that is in that area, we're going to go desert scape, so it will reduce the amount of water hitting the building as well, which reduces your day-to-day expenses. So these are all the things that you can do when you're thinking value add. I think a lot of people think, oh, I'm going to put money into a unit, I'm going to raise the rents, and that's my value add. But there's value add on the expense side too. If you can fix a lot of deferred maintenance that creates your day-to-day expenses, like, you know, like I was just saying, with having to fix the building because the sprinklers are hitting it, well, you don't have to pay that anymore. And so your day-to-day expenses are coming down, which means your NOI is going up, which is a value add in itself. We are going to install and charge for covered parking. This parking lot is huge. It's perfect for covered parking. And actually, we are also, one thing that was not known when we did this, we are also installing solar. And the solar company that we're working with, actually, they'll lease back the electricity for us, and we'll be able to pay 2 cents per kilowatt hour less than the city would charge us, but they will also pay for our covered parking that the solar is going on. So we're actually getting free covered parking, which was budgeted for $150,000. So that was a nice win that we weren't planning on as well. And then reduce payroll expenses. I mentioned the property management company. They had 3 people in the leasing office, 3 people in maintenance, which is way too much to be using on a 176 unit property. So we've got 3 maintenance people right now until we get caught up on the service calls, but then we'll go down to 2, and we have 2 people in the office. So we were able to cut 60 grand in payroll off the T12 on day 1. Here's our renovation budget. Won't go through it all, but you can see at the bottom there, we put in about 10.5 $10,500 per unit, or $1.8 million into this property. Unit upgrades is a big one. We're doing some parking lot work, landscaping. But the biggest thing here was we are saving this $135,000 for covered parking. And then you go down and we got 800 plus these fan coils, really $850,000 that we're putting into the boiler chiller to make it more efficient, to reduce our day-to-day expenses. So that's the biggest project really we've got going on for this property. And then just very light upgrades on the interiors where we've already proven that we can get the rents that we wanted. And we are doing cost segregation on this property as well. And I'll get more into that later, but on a deal where we're working with preferred capital, it was really nice because the preferred capital doesn't actually get any bonus depreciation. So we were actually able to give dollar for dollar to our investors on bonus depreciation. So if you invested $100,000, you got $100,000 loss on your K1 in year one. All right, here is the capital stack. And so this is where I'm going to talk a little bit about the preferred equity partner. Preferred equity is very difficult to understand. There's a lot of risks involved in it, but it can be very beneficial as well. We probably spent over a year courting them. They spent over a year courting us to build the relationship and the trust that you need. The thing about pref equity is that they're going to supply 36% of this capital stack, and they can literally walk out at any second for no reason. There's nothing tied to them. So if on the day before we close this property, they said, sorry, Kyle, we decided we're not going to go with this deal, we're pulling out, we would have lost our hard money, which is several $100,000s that was tied up into this property. There's nothing that we would have been able to do. So there is a relationship factor that needs to be built, and there has to be a lot of trust when you're working with pref equity. I would not suggest just working with a random pref equity group that you've never met or vetted before, because they really hold all the cards. But that first part of the stack there, the 5.9 million, that was the original loan, and that's the loan that we were assuming. And there's 8 years remaining on the loan. The blended interest rate is 4.52, so kind of high, and there's no interest only. So we're paying our principal and interest from day one, right? So this is why a lot of assumptions don't work, because they're low leverage. So meaning more money needs to be raised to close on the deal. They're higher interest rates, and there's not a lot of interest only. So they are a little difficult to make work. We got $1 million discount, which allowed it to work. The next 2 million there is called a supplemental loan. So we were able to add or get an additional $2 million from Walker and Dunlap to add on the property because the value had increased. And so they were able to add on another $2 million. So now our debt is actually $7.9 million on the property. And then the next section there, 5.9 million, is the pref equity, the one check from a single partner. And then that 2.5 million there is what we raised from our limited partners. All right, so benefits of pref equity. And I don't have a slide on the disadvantages, but I'll go over those on the back end. So pref equity is all negotiable as far as the terms that you get. So this is the terms that we negotiated. Sometimes it can be worse, sometimes it can be better. But on this particular deal, there's a cap on the preferred returns. So that means the limited partners and the general partners get all the upside. So anything above 13% that this property makes goes all to the general partners and the LPs, which is great, which inflates the returns. So this pref equity is capped at 13%. They are experienced partners, so they've done 500 million in real estate transactions, and they fought to be on this deal. So it's another set of eyes that have looked at this deal, vetted the deal, underwrote the deal, and said, hey, this is a good deal. So it really gave us an added sense of confidence when we went after this deal at this price. Mentioned this earlier, bonus depreciation dollar for all LPs in year one. You don't typically see that. And so 100% loss on their K1 in year one. And that's because pref equity does not participate in bonus depreciation. And because of all these things, the equity multiple is so high because there's so much upside after 13% on this deal that the equity multiple is 2.23. The downside I mentioned, is they control the money until you close. And then there's extra reporting. You know, we have to report to them on a monthly basis, aside from our investors, on however they want to see things. They get to come inspect the property on our dollar, on our bill. And essentially they can replace us as managers if we're not doing our jobs, which means that they would take over the deal. So working with the right lender is important when you're working with a pref equity partner, because not all pref equity partners want to see, or not all lenders are going to allow a pref equity partner to go in and take over the deal. So there's a lot of moving pieces with that. And these were the financial highlights. You know, the debt service coverage ratio is very high in years 1 and 2, and that's because of the low leverage. You know, we're putting a lot of money down on a deal. And so that allows our debt service coverage ratio to be so high. So, you know, on low leverage deals, I like them because they're less risk. Essentially, you have less debt service to pay for. The purchase cap rate on this is 6.3 on the T6. So if anyone knows Arizona, I mean, 4 caps are common right now, you know, and I think it's moving in the 3.5 cap range by the end of the year. So we were able to get this at a super low basis, which is why we love the deal, and would buy several more of these if we could. Low leverage, I already mentioned. These were the returns that we're offering on the profile, and it has to do because of that pref equity piece. If we didn't have the pref equity partner, we actually would not, this deal would not have worked, because that 5.9 million that they gave us is capped at 13%. If we were raising capital from limited partners, there is no cap. And so that 5.9 million would have no cap. And so the returns would have lowered dramatically. Break-even occupancy of 68%. We always look for a break-even of 70% or better. And what that means is economic occupancy is your actual occupancy or your actual vacancy plus what people are not paying, right? So bad debt, concessions, all those types of things. So it doesn't matter if you're 100% occupied if half the people are not paying rent. We want to know, hey, what is our break-even if we're if people are not paying rent? And so here, 68% of the people need to be paying rent, which we like a number of 70% or less. And that's it. So this is my contact information. If anyone wants to reach out to me, certainly reach out, but I'm happy to do any Q&A on this deal and answer any questions there are.
Cool. I can start with some questions, Kyle. So is the loan, I forgot whether, was it an agency loan that you assumed or?
No, this is actually a life insurance company. And so actually the assumption process, it took like 90 days because assumptions just take longer. The lender's not really making much money on the deal, so there's not a priority. But this lender was easy to work with. They didn't require any reserves, any additional work, which is nice. I know agency lenders will still require all the reserves. And so this is through an insurance company, and they were very easy to work with.
That's cool. And one crazy thing I saw was in your picture, I saw that there was a water vending machine in your laundry. Is that correct? Is that a thing?
Yeah, I don't know that that's there anymore, but some offer, you know, for 25 cents, you can get your water filled up there, or 50 cents or $1, depending on the market.
But do you make money on them? Like, can that be a strategy?
Yeah, you're not going to make a ton of money, but it's more of an added amenity for people that like it. You know, you may make $1 or $2 here or there, but it's definitely not a huge income generator.
Okay, so it's more like an amenity. Okay.
Yeah, for convenience.
Right. And what percentage of the people were Section 8? I forgot. Like
55%. When we first
55%. Okay.
We were first told we were at 35%, and we were already nervous about that number. Then when we did our due diligence, we found it was 55%. So we knew that our first 6 months were going to be a struggle at this property with crime, which we have had. Excuse me, and then with turnover as well. We're going to have a lot of turnover in the next 3 months because we are removing the Section 8 residents and putting in new residents.
So what do you say? Like, can you just invalidate the lease, or what is the process of like removing Section 8?
Yeah, so it's just like anything else, right? We can't break a lease, so they have to stay there the remainder of their lease. But if they're on a month-to-month, we'll just say we won't renew them. And if they are coming up on a lease due, we will just not renew and let them know that we won't be renewing them. And to be honest, like I said, the rents that Section 8 will pay, we're above those rents now. And so Section 8 will not pay for the rents of the people that live there. So they have to go essentially find another place to stay if they want to stay on Section 8.
Oh, I see. Okay.
Mhm.
But then isn't there a significant transition period? Because maybe the different kind of demographic have not yet accepted this property as theirs, and it's still identified as a Section 8, right? So what do you do in that period? Is it vacancy?
Yeah, so there's good look, Section 8 is not all bad, right? I mean, there's Section 8 residents that are good residents and
Mhm.
they treat the property with respect and they're good people. And then there's other ones that kind of take advantage of the system and take advantage of everything and that are not good for the property. So our goal is to identify the bad seeds and get those ones out. And those are the ones that are creating, crime on the property, bringing crime to the property, treating the property like crap, beating it up. Their units are terrible. Those are the people that we really want out. And so those are the ones that we're focused on first to clean up the property to make it safer for the residents. Because when we first took over, it was not safe. I mean, it's just not. And so we had to hire a lot of courtesy patrol. We brought on extra staff for protection in the office. We added cameras throughout the property. We let the local police know of the issues. We even got a council member involved to help clean up the area. So we're still working through those things because we're only 4 months in, but those are the things that we're focused on right now.
Wow, that's actually pretty hard to do, all of those things. Cool. Anyone else have questions? You can just unmute yourself and ask the question. Or if you want, you can type it in chat and then I can ask a question on behalf of you, whatever you feel comfortable.
I think you asked some really good questions because I did have a question on the Section 8 and transitioning it to, I guess, a regular rental. Because I thought out here, if the property is a Section 8 property, it has to remain at a certain percentage for a certain amount of years, I guess. Was this property not classified as that? I forget what the acronym is.
Yeah, sorry, I should have clarified that. That's a great question. It is not classified as a Section 8 property. It just has a high density of Section 8 because that was the last business owner's business model, right? That was the last owner's business model, and that's the last property management company's business model. Is they just load it with Section 8 and they get their guaranteed rent payments, and that's kind of how they do it. So we knew going in we'd have to turn that over, but if it was I'm not sure the acronym either, but a sanctioned Section 8 property by the city or the state, then yes, you would have to have a certain percentage of Section 8 remain in the property. But since it's not, we can lower that. Essentially, our rule of thumb is no more than 10% Section 8.
Cool.
Thank you.
Mhm.
One more question I have is about boiler and chiller.
Yep.
I think, so does that mean the whole AC system is centralized, right? For the entire unit, for the entire 176 unit. Is that correct?
Yeah, it's essentially driven off one area. And so the thing about boiler chillers that I didn't mention either is you can't have it heat and cool at the same time. So like, VP, if you wanted to turn on your AC and I wanted to turn on my heat, you can't do that. So essentially in the wintertime, we have the heat on. And then just last week, we switched it over to cooling. And so now people can put their ACs on. So that is the disadvantage with the boiler chiller is if someone's hot and they want to turn on the AC, but we haven't switched it over to cooling yet, they can't do that.
Oh, interesting. But it's probably okay in Arizona where the temperature is probably like, it just switches, right? And there's no it doesn't necessarily there'll be no cold days from now onwards.
Well,
right?
in the mornings, it still gets really cold out here, even though it gets hot in the afternoon. So there is that transition period. Now you can have fans and different things like that, or, portable ACs, but it's definitely not the most convenient system. If I had my choice, I wouldn't have a boiler chiller system, but you take that into account when you're doing your underwriting. You're going to have maybe higher turnover, a little bit lower occupancy. Maybe you won't be able to push the rents as much, and you'll definitely have more day-to-day expenses. But my rule of thumb is if you understand the game that you're playing and all the numbers still work when you put that stuff in, then we're willing to move forward with it.
Have you considered in your underwriting numbers to account for converting that system into individual units if it goes out, since it is older?
Yeah, so if it goes out, we would just replace it, and we are replacing all the lines, and the cooling tower is about $100,000. We know that the boiler chillers are about the boilers are about 20 to 30. So we have reserves for that. Converting it to HVAC, we actually looked at that for this property, and we would be able to drop our electricity bill by $120,000. So we wanted to do it. It's anywhere from $8,500 to $10,500 per unit, and the biggest issue we had was we were not sure the city of Tucson would provide us with more power. And so that's the biggest thing, because we're going to have to pull more power. And so that process takes time, and we didn't have the time to understand whether that could be done or not. And so we went with the business plan where we knew we had, we knew what was going to happen.
And maybe you can you're adding solar, right? So maybe you can get that power from solar. Because it's
we are doing solar, which will essentially lower the electricity bill, which is essentially passed on to the residents. But we're okay with that too, because if their RUBS bill is lower, that means their total rent bill is lower. If we're saving on the utilities, now we don't have to charge as much. So even though it's passed on to the resident, we still look at that as a value add, because we'll be able to lease up quicker.
Makes sense. Cool. Anybody else? Questions?
Did you check with the city to see if there were rebates for those units? Because I know that sometimes the cities provide rebates.
For the solar piece, or for
both the solar piece and the HVAC?
Yeah,
and so that could be something you do down the line, but just curious.
Yeah, so they do rebates for sure. Our issue was just the risk versus reward of having to raise all that capital and then finding out that the city can't pull the power, and then essentially we're stuck with what we already had. And so we were looking for more of a sure thing, and the city couldn't give it to us for several months, and so we had to move forward with that. As far as rebates for the solar, so the way we're doing is we're not actually buying the solar. We're actually having another company put it in, and then we're buying the power back from them. And that allows us to not put in $1 million for the solar while still saving. But yes, they do rebates for that, but that company will actually get those rebates.
Oh, that's interesting. That means you're doing nothing, but just paying slightly lower cost for your electricity. Correct?
Yep, exactly. And we're getting free covered parking.
Oh, because they do that as well.
Yeah, so the way it works is that they'll pay for anything that has to do with the installation of the solar. So if you were to put them on your roofs, they would actually repair your roofs for you. But that gets billed into the cost of their budget, which basically decides how much you're going to pay per kilowatt hour. So if we can reduce the budget to install solar, then we'll be paying less per kilowatt hour. So it's a balance, right?
Okay.
So right now we're paying 2 cents less. If we didn't do the covered parking, we may pay 3 cents less. But the covered parking is really the only place it can go on this property. So we get free covered parking. We save 150 grand plus 2 cents per kilowatt hour.
And then you also get the income from the covered parking, right?
And
correct.
we get the income from the covered parking. Yep. So we'll be charging $20 per spot for that. So that's a huge win.
Yeah, this is, I think, genius idea, because this is amazing. Because you're doing something good as well for environment friendly stuff, right? And you get to charge for covered parking, and you get pay less in electricity. Oh my God, I can't believe this.
Yeah, so that was a good one. That's not planned in our budget either. So that's just all additional, generated income to the bottom line. So that's great.
Cool. Alex,
Alex had a question maybe.
Yeah.
Yeah, again, this is my first time attending a meetup group. So I had two questions. So the deal that you are referencing, is that a 506B or 506C deal?
It's a 506B.
Okay. And how many total investor are generally it mixed up in that part? Did you max out at the 35? I think is the max.
35 is the max for sophisticated investors, but we can also add on accredited investors. So, you can have 100 investors on that, but you can only have 35 of those be sophisticated. In this situation, we only had 27 total investors, so we didn't hit that cap.
Got it. And were there a minimum investment for the deal that you're working on?
$50,000.
Okay. And another question I had. So you indicated like you were gonna leave some for the next buyer so they can have a little upside. Can you elaborate on that a little bit more?
Yeah. So what I said is that you want to leave a little meat on the bone for the next buyer. And that's because there is a larger buyer pool of value add investors than turnkey properties, right? So if you're buying a property and it doesn't have any room to raise the rents or improve the NOI, you're essentially just buying it for the cash flow that it currently sets off. And there's less people that want to buy a property like that than, buying a property that has some upside where you can increase the value of the property, obviously for obvious reasons, but also for the cash flow, right? So since there's a larger buyer pool of value add investors, I want to attract that buyer pool. And so you always want to leave more meat on the bone to attract that buyer pool.
And what was it exactly that you were leaving meat on the bone?
30% of the units won't be renovated.
Got it.
Yep.
But you would still lease them out, but they just won't be renovated. And
Right.
then you charge
So
those at a lower.
Yeah, they'll charge a lower rent because they're not renovated. So they'll be, some properties do 3 or 4 different levels of renovation. You can have a classic, you can have an upgraded, you can have a premium or platinum, and then a platinum plus, and so a lot of people do it that way as well. And you always want to leave a little bit of meat on the bone. So like for our 42 unit property, we renovated all 42 units, but then we implemented a platinum for 5 of the units. We only spent $1,200. We got $90 rent bump. And now for the next buyer, they can go implement that on the rest of the 37 units. So that's how we sold that one.
Got it. And generally with your deals, how long are you looking to hold until you are ready to sell to the next buyer? Yeah,
our general underwriting is 5 years. However, we take a look at the way we evaluate when we're going to sell is the velocity of our investors' capital. So, this deal 42 unit, we sold in 23 months because we stabilized it in 6 months. We took a look at where the market was. The market was compressing. It was a good time, and we can get our year 6 sale price in year 2. And so the velocity of our investors' money then becomes something where we can triple their money versus just double it. Okay, so when you're doing value add, you've got the value of the property going like this, but then it levels off at a certain point, right? It's not going to keep that trajectory. As soon as it kind of gets here, we want to look to possibly sell it or refinance so that we can get our money into another deal that continues with that trajectory. So it's all about the velocity of our investors' capital.
Got it. Just to be clear, so I think you indicated like a 2.35 return. Is that
2.23x on that one?
So meaning if somebody invested $100,000, their return is 2.3 times.
Yeah, so we would return 223,000 in that case. So 100,000 is their own capital, and then a profit of 123,000.
Wow, that's great.
Yeah, but that equity multiple includes cash and cash. I mean, the or not? It includes that, right?
It does include your cash on cash return during the life of the hold. So that's your total return.
Total return, exactly.
Yep.
Yeah.
Yep.
So you won't actually get 223K, but you'll start getting part of that as monthly distribution or quarterly distribution. And then if you total all that money at the end of it, then it'll be 2.23x.
Yep. Yeah, it's a combination of the cash flow plus the back-end profits.
Back-end profits, right.
And generally, once you get the investor and you purchase the property, how long does it take until cash flow start to come in?
Our rule of thumb is that the property cash flow is on day one. So we don't do, distressed, heavy value add properties. We're doing value add where the property still cash flows on day one, but you can increase the cash flow dramatically. So, day one, it's cash flowing. It's not cash flowing where we want it to be. So stabilization takes anywhere, depending on the size of the property, probably 6 to 18 months. Larger properties, 100+ units, are definitely 18 to 24 months. It depends on your business plan. How quickly are you going to renovate the units? Is a big deal. We do it over natural turnover, so 6 to 7 a month. There's other groups that maybe do 20 in a month, to get it there quicker. But they have to take on the burden of higher vacancy in those months while they do that.
Got it. Thank you for that. That was very helpful.
Yep, you're welcome.
Any other questions? Anyone else have a question?
So do you and Gary do long-term holds, or is it just syndication short-term holds?
Yeah, right now we do syndication. I mean, 5 to 7 years. So to some people that's long-term. Most they're longer, kind of flips for multifamily. We'd love to get into a longer-term deal, but right now we've been investing in more C-class assets and 1980s, 1970s. And so those are not ones that we would want to hold on to for a long period of time. We are looking towards more Class B assets, 1990s to 2005. Those assets we may hold on to for 10 years. But essentially our business model is to exit based on, as I was mentioning earlier, the velocity of our investors' capital. So we always take a look at how can we make more money for our investors. Does it make sense to hold, or does it make sense to sell? Does it make sense to refinance? So right now it's more of a sell sooner.
And I was wondering if you were able to beat the expectations for your the Midtown on Second, or at least meet the expectations.
We far exceeded it. We wouldn't have sold anyway. We didn't have to sell. That property was doing great, but we got our year 6 sale price before year 2, and so yeah, we exceeded those expectations. And again, the hope is to take that money, put it into another deal, and now triple their profits versus double.
Oh, so you held it only for 2 years?
It was only 23 months.
Wow, very interesting.
Yep.
Okay, so that means if you find a better deal, then you're going to sell it even before, as long as you're either meeting or beating the numbers.
We took a vote for our investors on that one because it was such an early sell. So we wanted to make sure they were happy with the returns and that they were okay with it. We got 100% buy-in on it. And so that's one of the reasons why we wanted to sell as well. So if we would have gotten some pushback on selling too early, then we wouldn't have done it. But the returns are fantastic. And again, we are going to get them into another deal where they're going to be able to now triple their money. So or at least, I mean, that's the expectation or the goal, right? But you can't promise anything and nothing's guaranteed. But now we've exited this deal, so they've made the return there, and they can take that money and that capital and redistribute it, which gives them more of an opportunity to triple their money.
Right, that makes sense. And then you said you have a asset management summit coming up, right? So how does it? Is it like, are these sessions during the daytime, evening time, or what is the?
Yeah,
agenda?
We switched it up from last year a little bit, but it is 7 days. And all the this year, all of the presentations are at, I think, starting at 2 p.m. Pacific till about 5 or 6 Pacific. And then on the weekends, it'll be from 9 a.m. to 1 p.m. But, they're recorded as well. So we do recordings. We sell the recordings and the VIP for $127. And the VIP also gets a fireside chat with each of the speakers every night. So let's just say 2 speakers are speaking today. You'd hop into the VIP room and you get to ask any questions that you want for 30 minutes with them. So, but yeah, it is over 7 days. We'll have 30 speakers and a lot of value for sure. And it's completely free if you just want to attend and pop in on certain things, just to learn about asset management.
Right. So technically I could just join and just hop in on weekends, and that should be fine too.
Yep.
Okay. That's perfect. Any more questions? If there are no questions, then I'm going to try to do networking, which is, I mean, at least we can have one session if you guys don't mind.
Yep. I'm going to go ahead and type in, do you mind if I type in the website where they can sign up for the?
Yeah, absolutely, absolutely. In the
summit?
chat box, yeah. And I want to stop recording meanwhile. amsummit2021.com.